95%. That's not a typo. 95% of people who try day trading lose money. We're talking about an industry that chews up retail investors and spits them out broke, confused, and wondering what went wrong. But here's what's really disturbing. It's not because those people are stupid. It's not because they didn't work hard enough. And it's definitely not bad luck. I'm going to show you exactly how the day trading industry profits from your losses. And by the end of this video, you'll understand why even smart, educated people get destroyed in this market. But first, you need to know something that brokers and trading gurus desperately don't want you to find out. See, there's a reason why every trading course, every broker, every financial influencer tells you that you can be the exception. They need you to believe that. Because the moment you understand the actual mathematics, the actual structure of how day trading works, their entire business model collapses. You're not just fighting the market, you're fighting sophisticated algorithms, billion-dollar hedge funds, and a fee structure specifically engineered to drain your account. And nobody told you this before you deposited that first $5,000. Quick note before we dive deep. This is educational content, not financial advice. Always consult with licensed professionals for your specific situation. Now let me show you the machine that's been quietly transferring wealth from your pocket to Wall Street's. And trust me, once you see it, you can't unsee it. 1. The problem setup. Let's start with Mark. Mark's not real, but his story is the exact same story I've heard from literally thousands of people. Mark is 32 years old, works in IT, makes decent money. He's smart. He understands technology. And he's been watching YouTube videos about day trading for 6 months. The videos make it look so simple, right? Green candles, red candles, buy the dip, sell the rip. These traders on YouTube are showing their accounts, $20,000 gains in a single day, Lamborghinis, beach houses, freedom. So Mark opens a Robinhood account, deposits $5,000. That's money he can afford to lose, or so he tells himself. He's not gambling. He's investing. He's taking control of his financial future. First week, Mark makes $300. Holy shit, it works. He texts his friends. He's already planning what he'll do when this $5,000 becomes $50,000. Second week, he loses $400. Okay, that's fine. Learning curve. He buys another course. This one's $997, taught by a guy with a Ferrari in his thumbnail. Surely this is the secret. Month 2, Mark is down $1,800, but he's learned about options now. Options have leverage. Options are where the real money is made. He's seen the screenshots. This is what 95% of day trading accounts look like. That little bump at the beginning? That's not skill. That's variance. That's the casino letting you win your first hand so you keep playing.
Welcome to the new era of video creation with HeyGen. Simply type your script to get started. Welcome to the new era of video creation with HeyGen. Simply type your script to get started.
Only 13% were profitable after fees. And of that 13%, only 1% made more than they could have made working a minimum wage job. Let that sink in. You have better odds at a casino. You have better odds buying lottery tickets. You literally have better financial odds doing almost anything else with your money. So why does everyone keep doing it? Why do 500,000 Americans wake up every single morning, open their trading platforms, and voluntarily participate in a system designed to take their money? Because nobody's telling them how the system actually works. Nobody's explaining the invisible tax that gets charged every single time they click buy or sell. Nobody's explaining that they're competing against machines that process information 1 million times faster than their brain can. But here's what the Wall Street insiders won't tell you. Let me break down exactly how this machine works, because once you understand the mechanics, you'll see why it's mathematically impossible for 95% of retail traders to win. First, let's talk about the invisible cost that nobody mentions in those YouTube videos, the bid-ask spread. This is the difference between what someone will pay for a stock and what someone will sell it for. And it might seem tiny, maybe 1 or 2 cents per share, but watch what happens when you're day trading. Imagine you're buying a stock at $50, but the spread means you're actually buying at $50.02, and if you sold immediately, you'd sell at $49.98. You just lost 4 cents simply by entering and exiting the trade, even if the price didn't move at all. Now, day traders aren't making one trade. They're making 10, 20, 50 trades per day. Let's say you trade 1,000 shares 20 times per day. That 4-cent spread? That's $40 per trade. Times 20 trades? $800 per day in spread costs alone. And that's before we even talk about commissions. Now, add commissions. Even if your broker advertises zero commission trading, and most do now, you're still paying. How? Payment for order flow. Your broker is selling your order to a high-frequency trading firm, and that firm is front-running your trade. They see you want to buy, they buy first, the price goes up a fraction, then they sell to you at the higher price. It's microseconds, it's pennies. But those pennies on millions of trades? That's how Citadel Securities makes billions of dollars per year. They're literally making money every single time you click buy. But wait, there's more. Now let's add regulatory fees. Every trade you make, the SEC charges a fee. Then your broker might charge data fees for real-time quotes. Then there's margin interest if you're trading with borrowed money. And most day traders are, because you need buying power to make meaningful returns. Let's do the math. You start with $10,000. You're paying the spread costs, the hidden payment for order flow costs, small regulatory fees, and let's say you're using 2-to-1 margin, so you're paying 4% annual interest on another $10,000 of borrowed money. Just to break even, not to make money, just to break even, you need to beat the market by about 3 to 5% just to cover your costs.
Welcome to the new era of video creation with HeyGen. Simply type your script to get started. Welcome to the new era of video creation with HeyGen. Simply type your script to get started.
Technical analysis for day trading is financial astrology. I know that's harsh. I know you've spent money on courses about head and shoulders patterns and moving average crossovers, but the academic research is absolutely clear. Technical analysis does not provide an edge in short-term trading. There's a great study published in the Journal of Finance that analyzed 5,000 day traders. Know what they found? The traders who used the most sophisticated technical analysis actually performed worse than traders who traded randomly. Why? Because complex technical analysis led to overtrading, which led to more fees, which led to worse performance. And those traders who are making money? Let's talk about them, because this is where it gets really interesting. There is a small group of day traders who consistently profit, about 5%, remember? But here's what they're actually doing that's different from you. They're not trading their own money anymore. Now here's where it gets even more disturbing. They're just me show you the evidence that the trading industry doesn't want you examining too closely. Because when you actually look at the numbers, the whole facade falls apart. The Brazilian securities regulator conducted the most comprehensive study ever done on day trading. They analyzed every single day trader in Brazil over a 3-year period. That's over 19,000 individual traders, nearly 4 million trading days, and 99 million trades. Here's what they found. 97% lost money. Not broke even, lost money. And the 3% who made money? Their average annual return was less than the minimum wage in Brazil. But it gets worse. The study found that the more someone traded, the worse they performed. The most active traders, the ones doing 50, 60 trades per day, they lost money the fastest. Why? Fees. Every single trade is another bite taken out of their account. Let me give you some specific numbers from that study because they're absolutely devastating. The average day trader in the study lost the equivalent of $4,200 per year. But they spent, on average, 800 hours per year trading. 800 hours to lose $4,000. That's $5.25 per hour in losses. They weren't just working for free. They were paying someone else for the privilege of having a job. Now let's talk about the industry itself, because this is where the real money is being made. According to industry reports, online brokers in the United States generated over $9 billion in revenue last year. Where did that $9 billion come from? From people like Mark losing their $5,000. The retail trading industry has exploded since 2020. Robinhood went from 3 million users to over 18 million users. E-Trade, TD Ameritrade, Charles Schwab, all reported record new accounts. And every single one of those new accounts is a potential source of revenue. Here's how the ecosystem really works. At the top, you have the brokers. They advertise zero-commission trading to get you in the door. They're making money through payment for order flow, selling your trades to high-frequency trading firms like Citadel Securities, Virtu Financial, and Two Sigma. Those HFT firms made over $12 billion in profit last year. $12 billion extracted from the market through speed advantages and information advantages that you, as a retail trader, will never have. Then you have the trading course industry. Guys like Timothy Sykes, Ross Cameron, Ricky Gutierrez. These people aren't making their money from trading. They're making their money from selling you courses. Ross Cameron's company, Warrior Trading, was sued by the Massachusetts Securities Division for operating as an unregistered broker-dealer. The investigation found that Cameron made more money from selling courses than from trading. And here's the really insidious part. These courses often increase your losses because they encourage overtrading. They teach you to get in the game, to take action, to not miss opportunities. Every trade you make based on that advice puts more money in the broker's pocket. According to documents from a FINRA investigation, one major broker specifically designed their app interface to encourage compulsive trading. Confetti animations when you make a trade. Push notifications about market movements. Leaderboards showing how many trades other users made. They gamified losing money. And it worked. Users of that platform traded 9 times more frequently than users of traditional broker platforms. And 9 times more frequently means 9 times more fees. But the most shocking part? The SEC knows all of this. FINRA knows all of this. The regulators have access to the same studies we're discussing. They know that retail day trading is a negative-sum game. They know that 95% of participants lose money, and they do almost nothing to stop it. Why? Because the industry generates too much tax revenue. Because the industry employs too many people. Because the system profits from your losses, and the people who could stop it are benefiting from the system. So now you're probably wondering, what does this mean for you? What does this mean for your money, your time, your future? Let me hand this over to someone who can break down the personal implications. Here's what this means for you, personally. Because understanding the system is one thing, understanding how it affects your actual life is another. Let's say you're thinking about day trading, or you've already started. You're probably telling yourself one of a few things. I'll just do it part-time. Or, I'll start small. Or, I'll be one of the 5% who makes it. Let me show you the real opportunity cost of that decision. Take that $10,000 you were going to use for day trading. Let's look at 3 different paths for that money over 10 years. Path 1. You day trade. Based on the statistics we've covered, you have a 95% chance of losing most or all of it within 2 years. Let's be generous and say you only lose half, $5,000. Your $10,000 becomes $5,000. Net result? Negative $5,000. Path 2. You put it in an S&P 500 index fund and forget about it. Historically, the S&P 500 returns about 10% per year. After 10 years, with compound interest, your $10,000 becomes about $26,000. You did nothing. You checked it once a year. You made $16,000 in profit. Path 3. You take that time you would have spent day trading, those 800 hours per year, and you invest it in yourself. Learn a skill that increases your income. Start a side business. Get a certification that earns you a raise. 800 hours per year is the equivalent of a part-time job. If you use that time to freelance, to build, to create actual value, and you earn just $20 per hour, that's $16,000 per year. Over 10 years, that's $160,000. Plus, you still have your original $10,000, which you could have invested passively. But it's not just about the money you lose. It's about what day trading does to your psychology, your relationships, your health.